Welcome back to The Explainer. If you've been watching the Australian housing market lately, you're probably seeing what looks like a massive domestic crisis, right? Well, according to the source dossier we're unpacking today, what we're actually looking at is a 30-year, carefully engineered systemic trap. It's a trap that was set into motion all the way back in 1999 with some specific tax reforms, and it's literally hurtling toward a massive global geopolitical flashpoint in the year 2027. So let's just dive right into how domestic housing and international economic statecraft got so dangerously linked.
So let's kick things off with a pretty cold, hard question. How exactly did a nation take a basic human need, shelter, and turn it into a permanent financial extraction machine? To figure that out, we've got to go back to 1999. That's when the government locked in a very specific and honestly explosive combination of tax instruments. We're talking about unrestricted negative gearing teamed up with a 50% capital gains tax discount.
And just to wrap your head around the sheer scale of the damage this combo caused over the decades, consider this. Before the year 2000, Australian house prices generally hovered around 3 to 4 times a household's income. Pretty standard, right? But skip ahead to November 2025, and the national median house price had absolutely skyrocketed to an astonishing 8.2 times the median income. The market just completely decoupled from the actual wages of the people trying to live in it.
Now you might be wondering, how did this mathematically happen? Well, historically, a house is what we call a consumption asset. The physical building ages, the roof leaks, it requires maintenance, it depreciates over time. But that 1999 combination of the 50% capital gains tax discount and unrestricted negative gearing, it literally flipped the script. It mathematically converted shelter into a currency. It manufactured scarcity. It basically created this environment where tax-advantaged investors systematically outbid regular owner-occupiers. And of course, that inflates prices, which then turns right around and validates the tax concession as a wealth creation tool, sucking in even more capital. It's wild.
Look at this number. By 2023, Australian landlords collectively recorded $11 billion in rental losses. Let that sink in for a second. $11 billion. Back in 1999, landlords were actually making a profit. Today, the system literally rewards them for losing money on rent. They take that massive rental loss, offset it against their regular wage income, all so they can capture those massive, tax-discounted capital gains when they eventually sell. The whole system practically demands skyrocketing prices just to stay afloat.
Okay, moving into Section 1, the Jenga Tower. 6 layers of conflict.
You see, housing in this system isn't just floating in a vacuum. It structurally supports the entire economy, kind of like a giant Jenga tower with 6 critical load-bearing layers. At the very bottom, obviously, housing has to provide shelter. For that, it needs to be affordable. But, and here's the kicker, the 5 layers stacked above it require the exact opposite. Over time, housing became the primary mechanism for wealth storage, a backup for an adequate retirement superannuation, the absolute foundational collateral for the entire banking system, a vehicle for speculative growth, and finally, the main revenue base for state governments through stamp duty. So here's the trap. You literally cannot fix affordability at the bottom without threatening bank insolvencies and completely cratering state budgets at the top. The system is mathematically prohibited from fixing itself.
Which brings us to Section 2, the policy architects.
Let's take a look at the specific personal and financial networks of the 3 men who spearheaded the 1998 Review of Business Taxation. This is the review that actually recommended those foundational tax changes we just talked about. We've got John Ralph, who spent his career running CRA, whose iron ore, by the way, fed China's massive steel industry. Then there's Bob Joss, who ran Westpac and also sat on the board of the Shanghai Commercial Bank. And finally, Rick Allard, who chaired EXA Asia Pacific Holdings, managing institutional capital across Asia.
The source dossier points out a really fascinating structural reality here. Their collective financial networks were just perfectly positioned to benefit from the massive capital flows this new tax architecture was about to generate. Think about it. A banking chief, a commodity extraction chief, and a regional institutional capital chief basically designed a tax reform that structurally redirected capital straight into appreciating property assets across the Asia-Pacific corridor.
Let's shift gears to Section 3. The 1996 Geopolitical Pivot.
To really understand the timing of all this, we have to zoom out and look globally. We need to trace this back to the 1996 Taiwan Strait Crisis. During that crisis, China fired ballistic missiles near Taiwan, and the U.S. responded by deploying 2 carrier battle groups. Now, Australia was the only government in the region to openly back those U.S. carriers.
As you'd expect, this led to an aggressive diplomatic freeze from Beijing. But just a year later, in 1997, Prime Minister John Howard led this massive business delegation to Shanghai. It was basically a commercial capitulation offered up as the price of diplomatic repair.
And this perfectly aligned with China's post-1996 strategy. Having faced the reality of its military limits against the US, Beijing completely pivoted to economic statecraft. Their strategy was simple, but incredibly effective. Build deep, structural dependencies in Western-aligned economies. The idea was that by deeply entangling commercial interests, any future military confrontation over Taiwan would just become prohibitively expensive for the political classes of those Western nations. And Australia, with its absolute wealth of resources and a suddenly very compliant government, was pretty much the perfect target.
So this architecture was quietly locked in under the radar. In November 2002, right during a window when Western intelligence was entirely distracted by the post-9/11 war on terror, Australia signed a massive 25-year Northwest Shelf LNG contract with China. Treasurer Peter Costello actually celebrated it at the time, praising the sustained cooperative efforts of many parties in business and government. That quote right there, that was the new commercial compact being openly declared at its most consequential moment.
And here is where the loop entirely closes. Australia sold all these commodities to China, generating massive budget surpluses. Those surpluses were then poured into Australia's sovereign wealth vehicle, the Future Fund. And what did the Future Fund do? Well, it took hundreds of millions of those dollars and recycled them right back into Chinese corporate equity, companies like Tencent and Alibaba, often running the money through opaque Cayman Island structures. The dependency wasn't just built, it was fully operational.
And that leads us to Section 4, the 2027 Convergence.
There are three major events converging in the exact year 2027. First, that foundational 25-year LNG contract we just talked about from 2002, it expires and requires renegotiation. Second, 2027 just so happens to be the stated military readiness milestone for the People's Liberation Army regarding a Taiwan contingency. And third, it is the year of the 21st Party Congress for Xi Jinping.
So at this exact moment of maximum strategic pressure, Australia's contract renegotiation leverage will be at its absolute lowest, while China's will be at its absolute highest. And the Australian political class, the very people who are going to have to make critical defense and alliance decisions regarding Taiwan, are personally and systemically indebted to a domestic property market that fundamentally requires those Chinese commodity contracts to stay afloat. They literally cannot break the commercial dependency without breaking their own property-denominated balance sheets.
Ultimately, the dossier leaves us with an incredibly profound question. As these AUKUS security agreements are being rushed through to bind Australia to the West, which architecture is actually going to prove more durable when 2027 arrives? Is it the commercial dependency and housing debt trap that was painstakingly built across 30 years, or the security architecture being rapidly assembled in just 6? Thanks for joining me on The Explainer today. We'll see you next time.